President Trump was inaugurated for his second term on Monday, and although he did not mention too much on taxes in his first actions, we know it's on his agenda for the year. Our next guest is here with 3 ways Trump could change your taxes. Joining me now, we've got Andrew Gordon, tax attorney, CPA, and partner at Gordon Law. Andrew, good to have you back on the program. Let's kick off with the first on your list, extending and expanding the Tax Cuts and Jobs Act. Tell us about that.
Yeah, thank you very much, Brad. It's great to be here. It's a very interesting time for tax policy now with the inauguration of President Trump. And the first big way that taxes can impact everyone listening today is through the Tax Cuts and Jobs Act. Now, the Tax Cuts and Jobs Act was originally passed back in 2017 during the first Trump administration. And the Tax Cuts and Jobs Act, or the TCJA, cut the tax rates across the board. So regardless of which tax bracket you were in, most likely you had a decrease in taxes after the TCJA was passed. However, it is set to expire in 2025. And so without action, your tax rates would actually increase. However, President Trump has vowed to extend the Tax Cuts and Jobs Act, keeping these tax rates, at least in the future, or hopefully permanent. The other big way is that the Tax Cuts and Jobs Act impacted those in high tax states even more because it had a limit on federal deductions for state income tax of only $10,000. President Trump has vowed to remove this limit. And so if you are in a high tax state, this could mean a much greater deduction on your federal tax return.
Next on your list under Trump, we could see the elimination of taxes on certain income types. So what exactly would that entail and ultimately mean for those specified income brackets?
Yeah, so on the campaign trail, President Trump had vowed to actually eliminate taxes for those that received income through tips, Social Security, and overtime. And so if you're in a service industry or a profession that generally receives most of your income through tips, this could mean that that tax is eliminated potentially in full at a federal level. Now, keep in mind, this doesn't impact state taxes. State taxes still apply, so if you're in a high tax state, you still have to consider that. But for those in service businesses and businesses that those that work for businesses that receive overtime, this again will mean a lot more income in your pocket. And another group that will be impacted is those receiving Social Security. President Trump also vowed to eliminate taxes on Social Security. So if these things go forward, it could mean substantial tax breaks.
And then lastly here on your list, Andrew, we're seeing the introduction of the External Revenue Service, which Trump did in fact announce Monday. Tell us what it can mean for taxes from your assessment.
Yeah, tax didn't come up too much during the inauguration, but one topic that did come up is the introduction of the External Revenue Service. Now, we're all familiar with the Internal Revenue Service, which gathers revenue or tax from internal businesses and taxpayers. But the External Revenue Service would collect taxes, duties, and tariffs from foreign sources, and specifically foreign businesses. And so imports will likely have an increase of tariffs of 10 to 20% on all imported goods. What this may mean, however, is an increase in costs for people making purchases, since there's now going to be an increase in tariffs on those deliveries. However, even the person that came on before me was speaking about how businesses may try to absorb those costs. So it's not necessarily a for sure thing that it will lead to an increase of consumer prices.
All right, let's change course here for a hot second. Stay with us, Andrew. We are under a week away from the official start of tax season, which means that your time is going to become a lot more scarce here. So we appreciate you taking some time ahead of it. But we're also heading out of the holiday time when people may have received bonuses or raises. Talk to us about how tax brackets work.
Yeah, so one of the biggest misconceptions about taxes is that you have a fixed tax rate or that it applies to your overall income. But in fact, the U.S. is a progressive tax system, which means that there's different segments of income that's taxed at different rates. And so if you received a raise or bonus at the end of the year, your tax bucket may increase. You may be now pushed into a different bracket. And these brackets range from 0% on one end to all the way to 37% on the high end. So depending on your level of income, different brackets, different rates will apply. Now, two points to consider is your marginal tax rate, which is your tax rate on the next dollar of income you receive, and also your effective tax rate, which is your overall or average tax rate applied to all of your income.
So how do raises or bonuses affect your tax bracket?
So if you're currently in one tax bracket, that means that certain portions of your income are taxed at different rates, all the way up to a higher amount. But now if you receive a bonus or a raise, your income is now higher and you could be in a higher tax bracket. But what is very important to know is that the tax is only applied on the supplemental portion above the tax bracket. So for example, if you have a $95,000 salary and you receive a $10,000 raise, but the tax bracket is presently $95,375, for instance, you're only going to be taxed at the higher tax bracket, 24%, on the amount that's over $95,375.
So what should you do if you got a raise?
One thing to consider is making additional contributions into a tax-deferred account, an IRA or 401k, for instance. If you do this, you might not even have an additional tax from this bonus or raise. Another thing that you could do is actually ask your boss to pay that bonus at the beginning of the next year. By doing so, it will be in the following tax year, and you'll have the entire year to spread or increase your withholdings. So you won't just have a big tax bill at the end of the year, you'll have more time to pay it. Another thing that you can do is review your withholdings. Your withholdings is what is taken out of your paycheck every time you get payroll. But since you're in a higher tax bracket, you may need to pay more taxes overall. So it's a good time to review those withholdings so you don't get caught by surprise at the end of the year with a tax bill.